but it's just slowly giving it all back. And we're basically back to where we were in the middle parts of 2020 for this stock. And if you go even further back, it's really the same place that we were back in 2018 at the very beginning of sort of this 5-year journey. And so I look at this and it's more of, what are you doing for me lately? And apparently lately it's, we're going to invest in smartphones.
Buying the dip, analysis, and warning. Would you dive into NIO stock dip headfirst, or should you be holding back? You see, different opinions have been clashing over whether now is the time to buy or stay clear of NIO stock. Today, we're diving into the heart of this debate, exploring real data and expert insights to uncover the truth behind the headlines. Is buying the dip in NIO stock a savvy move or a risky gamble? Let's find out.
This is a company that's struggling. They're not profitable. They might be trying to do cool things, and maybe that's where it started, is we have a cool car and then we'll go from there. It was largely the ambition of a company like Tesla, but there was always a plan. Tesla's plan was start with the expensive car, make a slightly less expensive car, and then get your way down to where you have a scalable, lower priced model that can reach the masses. You didn't see smartphone in that trajectory for Tesla.
It's been a roller coaster ride for NIO stock lately, with prices plunging to multi-year lows. While some investors see this as an opportunity to buy cheap, others question whether it's a wise move. Despite the stock's previous glory days when it soared to over $60 per share, recent years have seen a downward spiral. Factors like China's COVID lockdowns and economic sluggishness have hit NIO hard, leading to slower sales growth and increased operating losses. Although a potential rebound hasn't entirely been ruled out, recent data, including a significant drop in January deliveries, paints a gloomy picture. Even optimistic bottom fishers might hesitate to dive in, given the uncertainty surrounding NIO's recovery prospects. But let's not undermine NIO's current strides. Despite its stock price struggles, the company has achieved significant milestones in recent years. From its humble beginnings as a startup, NIO has transformed into a major player in the electric vehicle industry, with production numbers reaching thousands of vehicles per month. Notably, its latest report showcases impressive delivery figures, with over 55,000 vehicles delivered in the third quarter and 10,055 in January alone. With plans to introduce newer and more affordable car models, NIO aims to bolster its market presence in key regions like China, Southeast Asia, and Europe. Moreover, the company is intensifying efforts to enhance its profitability by streamlining operations, including significant workforce reductions. This strategic move is crucial for NIO, considering its substantial cash burn rate of approximately $35,000 per vehicle sold. However, amidst these achievements, NIO faces formidable challenges on the horizon. The Chinese market, saturated with numerous competitors, has triggered intense price wars among industry players like NIO, Li Auto, and Tesla. Additionally, NIO's European endeavors have encountered obstacles, with unsatisfactory sales performance and prevailing preferences for local brands posing significant difficulties. Concerns regarding future EV demand further compound the company's woes, particularly as analysts anticipate a slowdown following the initial adoption phase. Recent developments, such as Hertz's decision to sell off its EV fleet in favor of internal combustion engine vehicles, underscore the prevailing uncertainties in the EV industry. Meanwhile, it's crucial to acknowledge the growth and profitability challenges looming over NIO's horizon. While 1 month of poor delivery performance may not indicate long-term prospects, the company's ambitious plans for 2024, such as introducing lower-priced vehicle brands like Alps in China and Firefly in Europe, don't guarantee a swift recovery. China's ongoing EV price wars present a challenging obstacle, with major players continuing to escalate competition. This puts NIO in a defensive position, necessitating potential price reductions to remain competitive. However, such actions could exacerbate already low gross margins, resulting in high operating losses and cash burn. Consequently, there's a reasonable basis to anticipate further declines in NIO stock, especially if lackluster sales and significant losses persist.
The concern is the fact that they are seeing some intense price wars in China, and their competitors are just doing it better than them. Li Auto, for example, is up 76% this year. XPeng's up 64% this year. Now, I will say NIO and XPeng both are not profitable yet, but Li has grown its sales and is now the king of profitability in that China region. And of course, Tesla, another major name now in that region. So they're just looking like they're losing some of this competitive edge, but at least today's results, we're still able to see really healthy levels of growth.
Now, let's look closer at NIO's competition in the hyper-competitive electric vehicle space. The company faces the daunting task of capturing market share from both smaller rivals like XPeng and industry giants like BYD, which emerged as the world's top EV maker in 2023. In the fourth quarter of 2023, BYD sold a staggering 526,409 electric vehicles, surpassing even Tesla's sales figures. This dominance presents the significant challenge for NIO, especially considering its own sluggish delivery growth compared to competitors. In 2023, NIO delivered 160,038 EVs, marking only a 30% increase year over year, while BYD achieved a remarkable 62% surge in full-year EV deliveries. Additionally, XPeng experienced modest EV delivery growth, highlighting the fierce competition in the Chinese EV market. Amidst China's economic recovery and global factors like inflation and high interest rates, analysts predict a challenging year ahead for EV sales. Tesla's Elon Musk himself warned of slower growth during a recent earnings call, indicating potential headwinds for the entire industry. As larger players anticipate a growth slowdown, smaller companies like NIO may face an uphill battle to secure their position in an increasingly concentrated EV market dominated by a few key players. But before we move on, we just want to thank you for watching this far. So, what do the analysts have to say about NIO's stock in 2024? Despite the recent fluctuations in the electric vehicle market, analysts are closely watching NIO's performance and weighing various factors to assess its future prospects. One aspect that's catching attention is NIO's recent trajectory compared to other players in the EV space. While some competitors, like Lucid Motors, have seen a temporary uptick in their stock prices, NIO has struggled to gain momentum. This divergence has led analysts to question what sets NIO apart and whether it can regain its footing in the market. Looking at NIO's performance metrics, there's a mix of positives and negatives to consider. On the one hand, NIO has shown resilience in scaling up its production and delivery numbers, with impressive figures reported in recent quarters. The company's efforts to expand its product lineup and penetrate key markets like China, Southeast Asia, and Europe are commendable. However, challenges persist on multiple fronts. The intensifying competition within the EV industry, particularly in China, poses a significant hurdle for NIO. With established giants like BYD dominating the market and smaller players like XPeng vying for market share, NIO faces stiff competition on all fronts. Moreover, the broader economic landscape adds another layer of complexity to NIO's outlook. Concerns about an EV winter and slowing demand for EVs amid global economic uncertainties are weighing on investor sentiment. Additionally, geopolitical factors, such as potential tariffs and trade tensions, could further impact NIO's growth trajectory. From a financial perspective, NIO's balance sheet reflects both strengths and weaknesses. While the company has successfully raised capital in the past to fund its expansion efforts, questions linger about its ability to achieve sustainable profitability. The company's cash burn rate and operating losses raise red flags for investors, especially in a challenging market environment. In light of these factors, analysts are taking a cautious stance on NIO stock. While there's optimism about the company's long-term potential, especially with its innovative product pipeline and strategic partnerships, there are also lingering doubts about its ability to navigate the current headwinds. So, what does this mean for investors? Well, it's a mixed bag of opportunities and risks. While there's potential for NIO to bounce back and deliver significant returns, investors should proceed with caution and conduct thorough due diligence before making any investment decisions. So, is NIO stock a buy, sell, or hold in 2024? Share your thoughts in the comments section below. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know more about the realities of investing in NIO, just click this video right here. Thank you for tuning in and stay tuned for more exciting content in the future.